Hello, good morning. Good morning, good morning, good morning. Good morning, everybody. Good morning. Good morning. I'm happy we are all here this morning. Good morning, everybody. Good morning, good morning, good morning. Hey, good morning. Good morning, guys. Good morning, good morning, good morning. Thank you for joining. Thank you, everybody, for joining. Come on, join on and share. Share. We have some very, very important information to provide today. And I'm excited just to be here. Um, Jeez, my microphone is not working. Okay, but that's fine. Let's everything. If you can hear me, just put your thumbs up. Tell me we are all good. We are all here this morning to talk about some. We talk about those issues that are critical to our existence. Those things that we think that we need to get them done. We need to do on to get ourselves ready for to be winners in this life. We want to just be winners. We want to win. Just join and share. Join, share, join, share, join, share. Hey, I see you guys. I see all of you coming in. Please join, share, join, share. Those of you who are on YouTube, I am going from one platform to the other. That's why you might see me. It seems as if I'm looking at you, or maybe I'm not looking at you. I am with all of you guys, and great things to talk about today. The microphone is not the best, but my voice is going to be as high as we can. We've done a lot of these things without having microphones, so we should be fine, 100% fine. I'm excited this morning, very, very excited to be with you guys this morning. And today we are going to be talking about a topic that I think is the talk. It is we always go with what's hot in the market, what we need at this point in time. So today, our thing, we're talking about tax strategies. This is tax planning season. We are at the end of our tax planning season. We have to make things happen for ourselves. We have to make sure that we are well prepared for the tax season. And for those, I'm going to give you some very, very pregnant, very specific tax planning tools today. Very specific. I'm going to be as specific as I can, and I'll give them to you so that we can make sure we implement them. And those that you cannot implement, please contact us. We'll help you implement them. We have a few days to go, and there's still a lot we can do. If we can't do them this year, next year is another bigger year. We have to make these things happen. So, guys, we have 1 minute. Just 1 minute and we get going. Just give me one more minute and we get going. If you're there, just put your thumbs up. We are also live on YouTube, and I'm looking at different devices. That's why maybe I seem as if I'm not looking at you, but I'm looking at you guys. So the message is going to be very, very clear today. 1 more minute, join, share, like our page, click the notification button so that the next time we are on, you guys are getting you're getting the information. So guys, keep going, click, share, click your notification button, share, like, follow us on YouTube, follow us on Instagram, follow us on Facebook, Instagram, follow us on YouTube, guys, and share our broadcast, share so that next time, so that other people can benefit in this. Because these are things that are going to impact us like immediately. They are going to impact us immediately. This is what we call tax planning season. And tax planning season ends on the 31st of December. We have to make sure that we are on top of it. We are on top of it for ourselves. We are on top of it in terms of our wealth planning too. In terms of our wealth planning, we must be on top of the most expensive bill we have, and that's the IRS. The IRS is not only an expensive bill, it is also a tax optimization. It's also a wealth planning, wealth management tool. If you manage your IRS, if you manage your taxes well, you get access to capital. If you manage your taxes well, you get access to those things that you need in order to build wealth. And that is why we are so much into saying, repeating these things over. Some of you, those of you who have been on my broadcast, you might think it's a repetition, but they are all different. These are all different. These are all very critical tools. And I'm just happy. Leave your comments. I salute you guys. I salute you guys. Okay. So now we're going to start. We're going to start. And again, please go on there and share. Share, like our page, follow us on YouTube, follow us on Instagram, follow us on Facebook, and we will make these things happen. Every week we are online, and every day we have something we're posting that is going to impact your lives in one way or the other. So let's start by just giving ourselves a short prayer. Father, Lord, we thank you for today. We bless you. We glorify your name. And we are happy just to be in your company with your people today to share our knowledge, Father. You're going to guide us as we do this in Jesus' name. Amen. So the topic of today is 2022 tax strategies. We're talking about, we're going to have some Q&A, but most importantly, we're going to tell you how you can save over $100,000 in taxes. This is not something you do when you go to do your taxes. It's something you actually plan. It's something you have to plan for. If you don't plan for these things, it's not going to happen for you. So today I'm going to give you some key tools. I'm going to give you 15 tax strategies, and I will show you how those strategies are going to affect your taxes immediately, how much you're going to save. And I can assure you that 100,000 you could save as much as you can save. I mean, in some industries, I don't see why people will even be paying taxes at all. So I will start by saying this. The IRS is a government policy tool. It is a government policy tool. It is the fiscal policy vehicle for the government. It is used to direct the economy. So what I mean here is that government needs you and I, need small businesses to build roads, to employ people, to build bridges, to create businesses, to build that affordable homes, to provide all those things that they themselves can provide. And for them to do that effectively, they will direct policies towards the areas that are much more important to them. They will make policies that are incentivizing to those of you who are providing those services. And for those of us who are, for those areas where they don't need anything, they are going to maybe try to reduce the incentives in those areas. So tax planning. So the government basically creates these incentives for you to make these things happen, okay? So it's not like, I hear so many people saying that tax planning, that they believe that taxes is just something that the government is using to penalize people. No, the government is using taxes as a policy-making tool. So the reason I say this is that small businesses are really partners of the government. We are small businesses. We are the partners of the government. And when you create a business, or when you are anybody in any transaction, the first thing that happens, your first partner in that transaction is the government, because you share all your income with the government. Whenever you make a profit, you share with the government. It is only right for government to also give you incentives when they have access to when they can give you those incentives. One of the key things I'm going to tell you today is that the United States government doesn't need your money. I mean, I say this out of okay, maybe I'm saying it too harsh, but they don't. It's not like they need your money to survive, but they need you to make certain things happen so that the country is in peace, so that there is harmony in the country, so that we don't have social tensions. They need you to employ people. They need you to build all those things, to provide those amenities that they themselves cannot provide. And in order to do that, they'll give you incentives. So many people call some of those incentives, they are loopholes. Whatever you call it, they are incentives that are there for a reason. They are there to help you grow, to help you invest in that particular line of activity so that you can take those advantages. Let's talk about some of them. I say this because I hear most of the time, in one of the things that we do the most, CHN tax resolution, our job, which is one of the key components of CHN. Tax resolution as our job, we help people with resolving tax problems. And one of the things that I see mostly in our community is that people believe, most tax preparers believe that the best way of avoiding taxes is not reporting your income. If you have an income that you can actually not report it, the best thing is not to report. And some of us who have international businesses, we just don't, our tax people, some of our tax preparers would basically tell you, do not report it. I mean, it's a mistake. It's a mistake not to report income. And the reason I say this is that one of the biggest advantages you have in living in America is access to capital. I mean, you can move into a bank in the United States and within 10 minutes, you come out with $1 million. I mean, this is not, you all, those who, you know that. And for you to get access to capital, the reason we don't have access to capital, there are two things that will give you access to capital. There is your ability to pay back the money. The bank has money. The US government, through the Federal Reserve, they provide capital to the commercial banks. These banks at very low interest rates. So these banks, they take this money and in turn, they need you to come and take this money in the form of loans. And when they receive this money, when they give you this, when they loan you this money, their income, the main source of income for the bank is interest. And when you get this interest, this is where they make their money. So they have every incentive to make you come to get money. So what I'm saying here is that for them to give you the loan, they need you to show two things. Number one is your ability to pay that loan. And that ability to pay that loan is only shown in America through your tax returns. So your tax returns, the amount of income that is showing on your tax return will determine how much loan you can get in terms of money. So let's say you were making $100,000. You can get up to $500,000 or even $1 million because you are showing the bank that you are consistently making money. And imagine for some of us, for those of us who are small businesses, imagine you getting $1 million to invest in your business at lower interest rates. That is incredible. That's the biggest advantage for me. The biggest advantage I see in being America, because one of the biggest reason of business failures is capital, lack of capital. And if you're in a place where you can access capital, you don't want to throw that away. So number one is the ability to pay back. The bank only sees that through your tax return. So your tax return shows the bank that you have the ability to pay back. For me, I will tell you, you have to report your income as much as possible so that you have as much money as possible. The second thing the bank wants to see is your willingness to pay that money back. Some people have the ability to pay, they just don't have the willingness to pay. If you have the willingness, the ability and the willingness, how do you show your willingness to pay? You show it through your credit score. Your credit score is a accumulation of your history, showing how much you've been paying, you've been meeting your obligations. And if your credit score is right, and you have the right ability in terms of your tax return, when you go to buy a house, they ask you for 2 years of tax return. What are they looking for? They're looking for your income. So basically, what I'm saying here is that if there is no reason for you not to show your income, first of all, the law says that you pay taxes. Taxpayers are taxed on their worldwide income. So anything that you have elsewhere, you have to put it. Otherwise, if you don't report your income, it is called tax evasion. And tax evasion is a crime. So the government understands that people need to get some tax breaks. And that is why they tell you, okay, report your worldwide income so you can get access to capital to produce more money and then make the economy grow. And then some of us, we decide, oh, I don't want that. I'm going to keep my money away. I just find that not right at all. And I'm educating our community. That is wrong. The right thing to do is to leverage. Make sure you report your income correctly. Make sure you report your information correctly. And then use the services of someone who understands the tax laws to be able to make you avoid those taxes. Because the government understands. They have given you all the tools to avoid paying taxes. So we have, and that's why I say there are some industries in this country where I will not expect them to pay a dime in taxes, irrespective of the fact that they are, most of the people in those industries are some of the people who are the biggest millionaires. And that's why in our country today, we keep saying that the rich don't pay taxes. Of course, the rich don't pay taxes if they use what you call leverage, if they are leveraging the right people to work for them. So please, tax evasion is a crime. Not reporting your taxes is tax evasion, and it takes you to jail. There is something that is called tax avoidance. And tax avoidance is what I'm going to talk to you. I'm going to teach you about them today. Today we have 15 points that I've clearly stated out that we're going to go through. And these are points that I've made them in a way that you can actually just implement them on a step-by-step basis. And if you don't understand some, that's why we're here. Call us and we'll be here to help you do that. Okay, number one thing. I said I was going to give you 15. Number one is bookkeeping. And I say this is becoming some people will say it's becoming ridiculous, but I say that all the time. If you don't have your books and records, first of all, you pay crazy in taxes. Number two, you're going to be losing out on the opportunities that you could have taken advantage of because you are navigating in the dark. If you are a small business person, if you cannot hire the services of an accountant to provide those services, you can do them yourself. You can learn how to use. Some of these software are very easy to use, but keep something that is like a book of record. Some people have told me that, some people have seen, when I do resolution, one of the things I see is that some people believe that they can just use their bank statements. The IRS does not accept that. The IRS does not accept that for many reasons. They say, number one, they don't accept that because they believe that the bank statement doesn't show the real, the exact nature of your activities. And I've gotten clients who are complaining about this. They tell me that it is too costly to hire the services of an accountant. Okay, it's too costly. This is very costly to the taxpayers. And what they do, they would rather rely on third-party information, maybe on the bank statement. The banks are also making a lot of mistakes. And then the second thing is, if you have a problem with the IRS doesn't rely on the bank statements only. They will accept the bank statement, but they want to see other things. They want to see your billing statement. They want to see the statement of activity. They want to see things like your aging analysis. Those are the type of things they see to make sure. They want to see what you pay in cash. They want to see that. Those are the type of things that will help them that will make them know that you have reported accurately and correctly. So number one is always bookkeeping. Bookkeeping is number one. Always make sure you keep your books and records. Number two, we are going towards the end of the year. I tell people, why don't you buy a vehicle? Buy a vehicle for the business. When you buy a car for the business, let's say you're making money. You've made a lot of money, and then you're trying to avoid taxes. You look for those things that you can buy for which you can take deductions immediately. Buying a vehicle, some people have told me that, oh, my business cannot afford to buy a vehicle. But buying a vehicle, you buy generally some of these vehicles, most people buy vehicles on credit. And when you buy on credit, you haven't paid a dime. You just went to the dealer and took a car. You are able to deduct that vehicle immediately, even if you bought it on the 31st of December. There are so many. You can take what they call accelerated depreciation on that vehicle immediately, and that's going to reduce significant portions of your income. If it's a listed vehicle, what the IRS call a listed vehicle, you can still deduct up to $19,200 in the first year. That represents about $4,000 of tax savings if you were in the 22% tax bracket. That's a lot of money. So the second thing is, and in some categories, you can even write off the vehicle 100%. Some people are asking me, what if I cannot buy the vehicle under the business name? It is not about under whose name the vehicle is. It is about the use of the vehicle. If you have a vehicle that is used more than 50% for business, you can deduct, you can take accelerated depreciation on that vehicle, regardless of if it belongs to the business or it belongs to another person. So that's very important. Number two, buy equipment. Number three, you can buy equipment as well. As long as you buy equipment, you have made money. You're looking at your financials and you're seeing that, oh, this year I made $200,000 in income, in net income from my business. You made $200,000 in net income from your business. What does that mean? That means that if you are $200,000 will automatically put you in about the 24% tax bracket, assuming that you're married and everything, and that's your gross income that's the your adjusted gross income. So 24% tax bracket, maybe 27% tax bracket, a little bit higher. Let's assume that you are even in the 22% tax bracket. If you bought a car, let's say you bought a car for the business, you bought equipment for the business. Let's say you needed to buy some equipment for your business and you bought equipment for how much? Let's say you bought equipment for $100,000. Remember, you don't have to pay for the equipment. You just have to show that you have the ability and the willingness to pay. The supplier will give you those equipment. So when you take those equipment, you can write them off immediately, even though you didn't pay a dime for. So you can take those equipment, you bought them for how much, you can take them and write off against the 200,000, and you just reduce your income in half. So you can do that even towards the end of the year. If you're still looking at your financials and you feel like, oh, it looks like I've made too much money, you can do that now. There's still time for you to do that. It reduces, it's going to reduce. If you were that type of a guy who went and bought equipment for $100,000, you can reduce it for half. In half. You can reduce it in half. And when you reduce it in half, imagine you bought equipment for $100,000 and then you are 22% tax bracket. That's $22,000 of taxes that you just wrote off, that you just took off from money that you didn't even spend. You still have your money in the bank. It's crazy. Another one is reinvest in real estate. Real estate for me is the El Dorado of taxes. I say this from a very, very truthful standpoint. It is the El Dorado of taxes. When you are in real estate, there is something called a rep. It is called a real estate professional. If you qualify as a real estate professional, you basically can take all the losses. You basically, first of all, as a real estate professional, it means that any losses that you're incurring from that activity, which is probably another side thing that you're doing, any losses that you're making from there, you can carry it and cancel all your ordinary income, like your W-2s, you can cancel everything from it. And how does it work? Basically, what happens here is, once you are a real estate professional, what can you take on the vehicle? You bought a property for let's say $500,000 that you bought the property, commercial property. You put it there, somebody who's living in that property. You haven't paid a dime on that property. You can already take something that is called cost segregation. You can segregate all the parts of that home and then write them off immediately. Writing them off means that you are accumulating losses because you bought a house for $500,000, for $200,000. If you do cost segregation, about $300,000 of that property will come out in a way that you can accelerate the depreciation immediately. That's already more than anything that maybe you have it on your ordinary income. Then in addition to that, you can do depreciation. You do cost segregation, you separate all those things, and then you can do you do depreciation. You take all of that. It is an El Dorado. You're carrying with you hundreds of thousands of dollars in losses. And what can you do with those losses? If you can, this year you are going to cancel all your income with that. You carry the balance of the losses to next year. You keep carrying it until you use it completely. This is what billionaires and millionaires have been using. Donald Trump did not pay taxes because of this. In the 1990s, he made over $1 billion of net operating losses coming from his real estate activity. And those meant that for the next 20 years, he did not pay a dime in taxes. So basically, real estate, and you can be doing this over and over and over and over. So real estate is an area where I've written a lot on. I've talked a lot about it. So basically, there's a lot of material I can tell you and how you can really leverage real estate to make yourself, first of all, real estate is going to make you a millionaire. That's for sure. Number one. Number two, you are not paying any taxes. Number three, it gives you all the bases. It gives you access to capital. So there's everything there in investing in real estate. That's number four. So basically, I just told you that with real estate, investment in real estate, you can write off all your expenses, almost all, and still carry losses, as long as you qualify as a rep. It is called, and you are not, in this case, you don't consider this a passive activity. Another one, which is my number five. Number five is involve your children in your business. This is crazy. I can write a book on this one. Involving your children in your business is the most important thing I will tell you guys. And the reason I say this is because it is the number one way to building what you call generational wealth, tax-free. Repeat me on that. It is the number one way of building generational wealth, tax-free. If you take a child, let's say for some of us who have 3 children, first of all, the law doesn't tell you that the child must be this age before he works for you. As long as that child is providing what you call something, it's providing a service that is ordinary and necessary for that business in carrying the trade or business. It is providing any service that is ordinary and necessary. First of all, when you make your child help in your business, you're helping the child to know about money. You're helping the child to know what you're doing. You're helping the child to actually take over from you, because a business is supposed to be what you call a going concern. It's supposed to be a going concern. You teach this child. And then secondly, when you have your child, most of us have our children working for us. We are not just reporting it. So reporting it means that you have to give that child a contract. Number one, you have to put that child on payroll. Make sure that you are paying them what you call a reasonable salary. You give them a reasonable salary, maybe a wage you put them on, even if you're putting them on minimum wage. Let me tell you something. You have your child who's working for you. You have 4 children. If you're like me, who has many children, you take all your children, you put them together, they're working in your business. As those children are working in your business, you're paying them a salary. When you're paying them a salary, it means that those things that you were supposed to be doing for them, now you are still doing it for them, but the IRS is actually helping you do it for them. Because you will go and buy their Christmas clothes out of their bank account. You go and buy their whatsoever, their Christmas shoes out of their bank account. All those things that we normally do. We go and dress them. We do everything for them. We go and even put money in their student student fund, in their educational fund. You take money out of their bank account and put in an educational fund, which is for them, for their future. The most important. So all of these, as long as there's something now called standard deduction, as long as standard deduction is less than, is what it is. Today, standard deduction is 12,500, almost 13,000. So it means that if you pay that child anything less than 13,000, that money is not going to be taxable for the child. And then secondly, even if that money is not taxable and it is deductible from you as well. So if you were in the tax bracket, you just reduce, let's say you have 4 children. You take 12,500, you multiply it by how many? By 4. Then you are reducing it from your tax bill, because that becomes a deductible expense. Number 2, that child, you can take that money and put it in a 529 fund, in an educational fund for them. That money is going to grow tax-free, because first of all, as long as you take it and pay for education, it is not taxable. Number three, and which is most important, once this child, you're doing all the expenses for free. But the most important thing is that if you took that money that you are paying that child. You're paying each of those children. You have created a bank account where the money is being paid inside. You take that part, just part of that money, and then put it in a what you call custodial Roth IRA. You take just $6,000 or $5,000 every year that the child is working for you up to the time they get to 18. You take that money and put it in what you call a custodial Roth IRA. It means that, let me tell you what that means. Let's say that child was 12. By the time that money is going to grow, it is already taxed money. Even though it wasn't taxed for the child, it is considered tax because it wasn't taxable anyway. Number two, the custodial Roth is growing maybe at 8% interest. It is going to be there. A Roth IRA is money that you don't have access to until you retire. That money is going to be compounding in there. By the time that child gets to 59, when they're getting that money out, he has over $2 million sitting in that bank account for him. And that money is tax free. If it was any other money, it would have been taxed. But that one is tax free. So how is that not generational wealth that you're building tax free? So number 5, make your children work for you. There are rules around this. If you are interested in this, talk to me. I have written about this. I have details. We're doing it for many of our clients. Please talk to me. I'll help you with that. Another one is set up a retroactive S corp. Many people set up LLCs because someone told them that it's a great structure. They just don't understand how LLCs work. Okay, you set up an LLC, and then that's it. So the meaning of it, so the LLC doesn't really mean a thing to the IRS. It doesn't mean anything. When you say you have set up an LLC, you send it to the IRS. What does it mean? The IRS, an LLC simply means to the IRS that it is just a group of things that they are doing business. It doesn't mean a thing. When they take an IRS, if you are a single member LLC, it means that your IRS, your LLC you own it alone. The IRS just sees that, okay, this man is filing taxes, he's alone. They call it a disregarded entity. It is called a disregarded entity. And what's a disregarded entity? It simply means that they are going to take it and file it as if you were a DBA, and then it will be filed on a Schedule C. Simple. That's it. And a Schedule C. But if you are a multi-member LLC, where 3 of you that form the LLC, it is called a multi-member LLC. When it goes to the IRS just defaults it to what? To a partnership. And all these have something. So any money that comes through it is coming to you as self-employment income. And that self-employment, let's say your LLC made $100,000. That was the profit you got from your LLC. Once you get your LLC, you get that $100,000. That $100,000, before they even start talking about taxes, about anything, about the normal taxes, they will first apply 15.3% on that money. So you are going to pay $15,300 directly to the IRS before anything. That is called self-employment tax. So basically what I'm saying is, rather than allow your LLC to just be going, and I see that all the time. I see people who have had LLC for more than 10 years, and their accountants or whosoever is preparing their taxes, they have been they have been a disregarded entity for the last 10 years, and they've been making significant amounts of money. Every year they are paying to the IRS like crazy, just because the person who was preparing their taxes doesn't understand a thing about the structures with the IRS. When you are set up you can retroactively set up as an S corp, even as of now. If your year is almost ending, we are almost at the end of the year. There are ways you can actually get an election. You get what they call an election to file as an S corp. When you file as an S corp, let's take for example that single company which we talked about, which made $100,000 in net profit in taxable income. Now, when you go and make an election with the IRS to be taxed as an S corp, what it basically means is that you're telling the IRS that IRS, I am now a corporation. I have moved from being a membership organization company, and I'm now a corporation. And that corporation, which is called Charles and Sons or whatever it is called, it is now employing me as an employee. I'm no longer self-employed. I'm being employed by that corporation. And when I'm being employed by that corporation will pay me what they call a reasonable wage, a reasonable income. That reasonable income, let's say you made a profit of $100,000 and then you ended up paying 15.3% of self-employment tax because that was income for you. Now you are now an employee for the company, and the company decides that we are going to pay you $20,000 a year. What does that mean? It means that 15.3% that was applied to the $100,000, it's now going to be applied only to that $20,000. That $20,000, when you apply that to $20,000, you're saving your tax is going to be $3,000. So you just move from 15,300 that you were going to pay before you even calculate taxes. Now you've moved from 15,300 to only 3,000. So you just saved $12,300 just by restructuring yourself. That is a very, very key one. Let's talk about this. And if you have a problem, if you have a company that you have not been structured properly, talk to us. We'll help you to structure that. Number seven is you have to establish payroll levels. I just talked about the LLC, and I talk about registering as I just talked to you about setting up a retroactive S Corp election for the year, and you can still do that up to the end of the year. Number two, you have to establish yourself a reasonable payroll. We've talked about that in a way when I talked about the other one. You set yourself a reasonable payroll. You were supposed to pay $15,300 in self-employment taxes. Now you're only going to pay $3,000. So you just save yourself $12,300 by setting yourself a reasonable payroll. The key here is that word reasonable. That reasonable payroll, you have to understand what they mean by reasonable. And once you understand that word reasonable, and you can get someone to give you what is a reasonable salary, reasonable payroll, then we have set that up for so many people. The IRS will never come back to it based on, we have certain rules that we look at to see what's reasonable for you. And then we make sure that you're meeting all the requirements, and then you avoid $12,500 taxes just for that portion of the tax. Number 8. Another thing that you can do for businesses. I do a lot of businesses and I look at their financial statement. We do bookkeeping, we do accounting, we help companies with that. You look at the financial statements, you look at your financial statements as you're moving towards the year, and then you're like, business is growing. My business is growing. When it's growing, the IRS is also happy because he's your partner. He's going to take more money. Unless you do something called leverage and helps and do the right things to avoid taxes. So what do you do with shifting incomes? So basically, with shifting incomes, most businesses are actually taxed on cash basis. Most small businesses, 90% of small businesses are taxed on cash basis. It means that the amount of money you receive, the cash that you receive, is going to be taxed in the year it is received. Okay, those are actual receipts only. So if you bill $100,000 a month and collect that $100,000 for the 12 months in the year, you just made $1.2 million in that year. And if you're in the 22% tax bracket, that's $22,000 of taxes, assuming everything equal. So you are paying $22,000 on taxes. No. Yes, $22,000. If you're 22% tax, no, 1.2 million. That's not $22,000. That's $220,000. $220,000 if you were there, assuming everything equal, and that's your taxable income. So basically, what you will do is that with income shifting is that you know that, okay, I have billed for 1, 2, 3, maybe 11 months, and I'm already on $1.1 million. Okay, I'm not going to collect for this month. I'm going to shift it into January of next year. That way, if I shift the income, I'm not going to pay taxes now on that income. I'm going to pay next year. That is called shifting of income. When you shift income, you push the taxes ahead. And then maybe you know that next year I'm not going to make as much money as I made this year. There was something particular this year, and I don't want to pay all these taxes. You shift some of that income into the future year, and that way it's going to be taxed in the future year. That's very important. So another one, when you do shifting of taxes, that also applies to expenses as well. Okay, because expenses, unlike incomes, which are taxed on a cash basis for most people, expenses are mostly on when they incur. When you incur those expenses is when they are going to be paid. So basically, you went and bought in, like in America, most people buy things they don't have cash. It's in Africa where we need to buy things on cash. Here, you don't even have the cash. So you just go and say, okay, I need a truck. You could just go to the dealership and get the truck. Oh, I need a machine. You just go and get it. So basically, I need supplies. You can actually buy more supplies without any cash outlay. You go out there because you have the ability and you have the willingness to be paying people, to be paying your debts. They will give you those things that you need. As long as you buy them and you have a contract that agrees by the 31st of December, then those expenses are going to be deductible on your taxes. So you can buy more things than you need now because you're going to need them in the future. So you are shifting. You're playing with your what? You're playing with your you're playing with your current assets. You're buying certain things that you need in the future. You're buying them now and increasing your costs. That is another very important one. Expense shifting. You do that as well, you're going to see in the same light, you're going to save significant amounts of money just by doing those shiftings. Another very big one. This one is a whole book on its own. It is retirement savings. Retirement savings is a huge one. And the reason I say it's a huge one, retirement savings. I see your question, Emma. I'm going to answer your question. Just keep hanging there. I'm going to answer your question as soon as I'm done with this one. So, retirement savings, that's number 10. There is something called, when you are a business, I tell people in the United States that when you are in the United States, the most important place you want to be is to be an entrepreneur. Because the government is not in partnership with an employee. The government doesn't have a partnership with you. The government has partnership with your boss. So he gives incentives to your boss to keep you there. And while he's giving incentives to your boss, he's making sure you pay the taxes. So before you even get anything, you're paying taxes. So until you get a side gig that you're doing, you're not in partnership. You're the guy who is funding all these activities for small businesses. That is the way it works. So basically, when you anybody who has a W-2 job, you should look for a way to have a side gig. That side gig gives you something. There is something that is called retirement savings. So if you're working for somebody, let's say you're working, what happens with 401ks, for example? In 401k, the contribution for a year on a 401k is about $19,000 for 2022. So what happens is that if you're working for an employer, you basically want to maximize your contributions into the 401k. The reason you're maximizing is that when you put money in that 401k, first of all, it's not taxable. It is tax deferred. So you're not paying any taxes on that portion of the money that you're putting in your 401k. Now, you're only going to talk about taxing it when you remove that money in the future, when you retire. When you retire, your income is less. So you don't want to be paying the taxes. Even when the taxes come, you're in the low income tax bracket. So you want to call your employer and ask them what's the maximum and make sure you maximize, you're putting more in your 401k. And another reason for doing that is that when you put money in your 401k, you put money in that 401k, your employer also matches it. So you want to take the most out of your employer to make sure that you're always capping your 401k if you have the ability to do so. That's number one. Number two is something that you want to, there's something called solo 401k. This is an El Dorado for small businesses. Because when you are still strong, you want to save money somewhere so that you can use it, you can be using it when you retire. First of all, you have money. You take the solo 401k. Even if you are a W-2 employee and you just have a side gig, you still allowed to be able to get a solo 401k as a solo. Solo is for self-employed. So basically, you are putting money, instead of leaving that money there and paying taxes, you put that money in your retirement and then you defer the taxes going forward. Incredible. So these are incredible vehicles for you to put money inside, for you to avoid. Remember, the solo 401k, you have to do it by the 31st of December. So for small business owners, that is an incredible pocket for you. And for those who are employees, if you're an employee, you maximize on your 401k. And there's one thing you can do with all these 401ks. You can actually self-direct your 401ks. Crazy. So you ask me, what is that? So self-directing a 401k means that you are taking that money. You instead of putting money and allowing someone to go and invest it in the stock market, in stock market for it to crash or do something. You can decide that I don't want to put my money for some manager to be managing it for me. There's a way that you can actually self-direct your 401k and invest in it. Buy real estate, buy property, buy these things. And as you're going, those properties, you put them as commercial properties. Someone is paying for them. When you are eligible for take the money out, you have millions and millions of dollars sitting in there because the property that you invested in, they have become yours. And then you have interest, you have money. I mean, it's just crazy. And then all the earnings that you have on that money is just going into your 401k account because you are not allowed to use it while you're still there, but you're maximizing your money. It is called self-directing your 401k, self-directing your retirement benefit. Another one is contributions to IRA. So every year you can max up to $6,000 in your IRA. IRA is individual retirement account. So and this one, if you make sure, if that's something you can do, put money inside. You have all these vehicles to put money inside. And the thing with IRA is that you just have to create it before the end of the year, but you don't need to put the money until by the time you're filing your taxes. So you have time to put that money in there. But by saving, okay, if you put $19,000 in your 401k, $19,000 multiply it by, if you're in 22% tax bracket, you're saving about $3,000. You're saving about $5,000. You put $6,000, you're saving about $1,500 in taxes. Just direct money that you have paid to the IRS, you're keeping it in your pocket. And then you're helping to grow your what you call wealth. This is what you call wealth building. Another one, number 11, charitable deductions. What are charitable deductions? For those of you who qualify, for those of us who qualify to use what they call, for those of us who qualify to do itemized deductions. Itemizing your deduction, because there are two types of deduction. You can either take a standard deduction or you take an itemized. If you take a standard deduction, then giving money to charity doesn't really help you. But if you are already on what you call itemized deduction plan, you qualify for itemizing your deductions, you can give money to charity. And giving money to charity, how do you even give money to charity? You must not pay the money right now. You can go and then take things on credit and give to the charity. You can use your credit card to fund the charity. So a charity of your choice, instead of giving that money to the IRS, you go and look for a charity of your choice and say, okay, I love this charity. This is a charity that I really want to grow. Let me put money inside. You put the money inside. And then you just save yourself. If you put $10,000 in a charity and you are in your limitation for AGI is 60%. So you can put up to, so $6,000 is deductible and you're getting a tax saving of $1,300. Incredible. And for most of these things, you didn't even pay for the money because you took it on credit. Another one. We've talked of number 11. Let's talk of number 12. There is something called HSA, Health Savings Account. Many people don't know about HSA, but HSA is one of the most important vehicles for most of us who are aging. Aging means you're getting older. And as you're getting older, you're looking for vehicles that you can save on medical insurance, on medical health. So apart from just and most medical insurance have a high deductible plan, which means when you go to pay, your copay is very high. So if you have a high deductible plan, you are allowed by law to be able to have what you call a health savings account. So you open that with a financial institution or with a bank. You go and there are accredited institutions for that. You go and create an account in there. You put your money. You can put up to how much? If you are married, couple, you can put up to 7,300 for 2022. And then you can even put more than that if you are more than 55. So you put that money in there, and then that money is growing in there. And then you, as long as you're using that money only to pay for your medical bills and that of your family, you're not paying any taxes on that money. Even the money as it's there and it's growing, even the growth is tax-free. That's a very, very big one. And it helps you with your personal as well. Then you have something called Roth conversions. Roth conversions. Many people ask me, Roth conversions is another place where I see a lot of value. So here it's about strategy. You're trying to optimize your personal, your wealth position. So instead of saying that, okay, you're making money, or maybe you're not making a lot of money now, but there are some people who are not making a lot of money in a particular year, but they have a lot of cash. So what you do is that, okay, I have money. Instead of me, or you've made money, you say, instead of me, what I'm going to do is I'm going to convert my traditional IRA, individual retirement account. I'm going to convert them into a Roth. And the reason you want to convert them into a Roth is that when they grow in the future, maybe when you retire, when you start looking at them 10 years down the line, they have grown significantly because you invested them, or maybe you are self-directing their investments. And then they are making you put in, maybe you put in your converting, whatever, they have grown and they are tax-free. So you want to do that now. When you convert a Roth, when you convert a traditional IRA, which is individual retirement account, into a Roth IRA, you are going to pay the taxes on there now, but you're saving yourself from any taxes on the growth of that money. So that's something many people like to do because they want to grow. And then when they are taking the millions are tax-free, whereas you only tax maybe tax $200,000. And those $200,000, you've self-invested them. And then they've grown into millions and they are all tax-free just because the initial capital that you invested in it was already taxed. So this is another one, Roth conversions. Number 14. When I set up a company for people, and this is important, some of my clients here would tell me that, oh, maybe I didn't set it up for them, or maybe you. So what I'm saying is, when you set up an LLC for somebody, one of the things that I always advise my clients is, when you set up the LLC, also create an operating agreement. The reason you want to get an operating agreement is because one of the reasons is what you want to insert in that program. You want to insert in that LLC what you call an advisory board. That advisory board is like a board of directors in a corporation. So you just created, because it's an LLC, you created an advisory board. That advisory board is a governing board. They are those that discuss about the running of the business. They discuss about the future of the business, and then they make certain decisions. So when you create an advisory board, they don't tell you who you can put in an advisory board. Any of your children who is above 18, you put them in the advisory board. And then you put your wife, you put your husband, you put your spouses inside the advisory board. And then what that does is that when you have these people in the advisory board of your business and the business is doing well, it means that the day you want to go to Cancun for your weekend, you can decide that, okay, we are making a board meeting, an advisory board meeting in Cancun. And then all of you travel to Cancun. And then you sit in Cancun, you have your fun, but you have time to sit and talk about business. When you talk about business, you're saying that the advisory board had a meeting in Cancun, and that's what we did. All those expenses, your lunch, your food, your travel, your this, it's all legally deductible. Legally deductible. You can decide to go on vacation back to where, and then you decide to put that as part of the legally deductible expenses, and then they are all legally deductible. So that's a good one. So your trips, your passport, everything is written off. Number 15. This is the last one. This is the last one of this series, but I can give you more than 50 of these strategies. The other one is what? You want to restructure your business. So basically, at this point, and I say this out of my experience in tax resolution, the experience I have in tax resolution tells me that many people and even many entrepreneurs, there are so many people who have created so many businesses. They have created, oh, LLC for this, LLC for that, LLC for this. You have created 1 or 3 or 4 or 5 LLCs, and then only one of them is operational at the end of the year. So basically, what I tell people, and then you ask them, what has happened to the other LLC? You say, well, I've not been using it. You're not using it. What's going to happen is that LLC is creating liability for you. It's creating problems. The IRS will send you something. Before you know it, there's somebody who is going to send you a lawsuit because of that other LLC. So what I tell you is that as part of your structure and arrangement and bookkeeping at the end of the year, you also look at your different you look at your corporate structure, and then any entity that is lying there that is loose, right? Just go and then properly go and deregister that entity. Go and deregister that entity so the entity is now legally separate from you. It's no longer existing. And in the same vein, and the reason you do that is because you're limiting yourself from trouble with the IRS, because down the line, you're going to get letters coming to you. You're also limiting yourself from trouble with third-party liabilities, claims regarding the business. So basically, that's number one. Another thing you want to do, which is important, is also you want to decide, I want also have this couple of businesses that I want to create in the near future. I want to create next year. So you can also decide, in as much as you're deciding on closing entities because to avoid any problems with litigation, you're also deciding on creating new entities. And new entities, you want to close old entities at the end of the year and create new entities at the beginning of the new year. That way you don't have partial returns, you don't have half-year returns, which are cumbersome and very tricky. So having said that, I have gone through 15 tax strategies. And in some of those strategies, I even went beyond. So these are things that we can use without necessarily trying to evade taxes, without necessarily going about, oh, how can I not report this income? When you don't report income, you're killing your activity. You're killing yourself. Report your income. Show these people that, okay, you are actually contributing to the economy, you're contributing, and then also show them that you are a credit-worthy somebody. But not only are you credit-worthy, they will give you the credit that you need to grow your business. That is a very important thing I wanted to say here. I have a few questions that came in from individuals. I have this question that came in from Emma. Emma says, what advantages can we benefit from earned income? So there are two things, and this is very important question, Emma. Emma, an earned income is anything that you have worked for. Anything that you have worked for is earned income. There is something unearned income is something that is given to you. You didn't work for it. For example, interest income. You put your money in the bank and then you're sleeping. That interest is going to create it's going to create that you put your money in the bank. The money is going to create some interest, and then the interest is going to come to you. So that interest income is passive income. It is unearned. For example, another one is when you don't work during the year. You didn't work, you have unemployment. Unemployment is unearned income. So unearned income is that income that is coming because, or maybe you go and invest in some real estate property and then you are not actively involved in it, and then they just send you your own your dividends. Those are all passive activities. They are called unearned income. When you have an unearned income, unearned income doesn't allow you to get, one of the benefits of earned income is that you get something that is called earned income credit, depending on your income level. You get earned income credit. And then you use it also in order to access certain benefits that are only available for earned income. Certain credits are only available if you have earned income. So if you didn't work all through the year and you met me partway through the year and you told me, Charles, I've not even worked this year. I don't even know how I'll get, even I'll get even a refund this year. I'll tell you, go work a little bit, have some earned income so that you can use that unearned income to have some tax credit. If you don't have earned income and you only have unearned income, you might not be able to have any credits. And then the standard deduction levels are very, very low for unearned income. I hope I answered that question. Another question that Emma is asking. Emma is asking, how do you know if you qualify for itemized tax deduction? Great question. So itemized tax deduction, remember there are two things that are given to you when you're preparing your taxes. There is something called standard deduction. Standard deduction is a number that's given to you. As of today, the standard deduction of a single person is almost $12,600. It's somewhere around there. Then if you are married, it is 2 times that number. If you're married and you're filing jointly, it's 2 times. But if you're married, you're filing single, you're filing separate, it is still 12,600 around there. Then if you're head of household, it goes up to about 19,000 because it's yourself and you're taking care of other people in your home. So standard deduction is a given number that you reduce from your adjusted gross income to arrive at what you call taxable income. Okay? But you can either take the standard deduction, which is that number that's already given to you that I've just outlined to you, or you can take something called itemized deduction. Itemized deduction has different types of elements that you consider. So if you have mortgage, you have mortgage interest deduction, you have property taxes, you have things like health bills, healthcare expenses. You have things like what? You have things like sales and other local taxes. All those things, insurance, some property insurance, all those things, you add them, they are given the items that must go under itemized deduction. If you put those items and you have them and they happen to be higher than that standard deduction, then you can use the one that is higher because it will give you a higher deduction. So you qualify for item. Everybody qualifies for itemized deduction because you can have a lower itemized deduction and still decide to use it. The IRS allows you to do that. But for real cases, itemized deduction is really, if you put all those numbers and they are higher than the standard deduction which is given to you, then you will take the itemized deduction. So I know where your question is coming from. Is because I was talking about the other item of charitable giving. Charitable giving is one of those items that goes under itemized deduction. So if charitable giving if you are already getting itemized deduction, charitable giving will let you add more itemized deduction, which is already making it bigger than your standard deduction. So I hope I answered that question. Perfect. Any question? I see another question. Another question is coming. What are the tax advantages that an LLC has over an NPO, non-profit? I think NPO is non-profit. So a non-profit is a corporation. It could be an LLC as well. It's just for a non-profit is just really it is an election that is being given to you by the IRS. So you have a company that you've created. You've created a corporation, and then that it is a normal corporation that you created with your Secretary of State in the state in which you are. Then now you want to provide those things that qualify as non-profits. You want to provide services that are benefiting the community. You are not there for a profit motive. If your intent is to provide services to the community and not making profit, then you can go to the IRS and say, Mr. IRS, I have this organization that I've created. It is an organization that I'm doing A, B, C, D, E, F. And these things are all benefiting just the community. I don't do it for myself. Can you give me a 401k? Can you give me a 501c3 or 501, whatever non-profit status you can give me? They will give you that status. That basically means that your activities are not taxable. So they give you that status as a non-profit, meaning that you are not a profit-making business and you're not going to be paid taxes. But now, if you go ahead and do things that are not within the framework of that non-profit, they might withdraw that license from. They might withdraw that election from you. And once they withdraw it, you're going to pay taxes for all the previous activities. So the question again is, what are the tax advantages that an LLC has over an LLC will pay taxes unless that LLC becomes a non-profit, and in which case the non-profit will not be paying taxes. Yes, so I have another question here. I have another question which is coming from who is that? From Mireille in Texas. She says, the state of Texas has it that it is illegal for someone to employ anyone under the age of 14. She's asking, when can I have my children work for my company? Oh, yes. Great question. Your children can work for your company at any age as long as they are able to provide services that are ordinary for the type of business you're working in, and the services are necessary for the services for the type of business, for the operations of the business. So ordinary in every business. Ordinary means if you go to another business that is the same like yours, you will see that that type of service is required. Ordinary, and then necessary means that it is necessary for the growth of that business. So if you have a business that is, if your child is providing any service that is ordinary and necessary, the state of Texas allows you to be able to get that child to work for you. Having said this, there was a court judgment that was passed in court, which regarding a situation where the court basically adjudicated that after the age of 7, a child was reasonable enough to be able to work in the business. So basically, generally, you just want to be above that age of 7, as long as a child is able to do some minimal type of work. If they are doing work, make sure you're paying them. You're not paying them more than the value they are bringing to the business. If they are bringing work, children are always doing online. They are bringing Facebook thing. They are helping you with Facebook. They are helping you to clean some material. They're helping you to clean the office. They are helping you to remove things. So those things you have to make them account for them and also be able to pay them for those services. Because if you pay your children at this young age, you are able to build more wealth for them while they are still young. Any other question? Another question is, how does being a real estate professional help in my tax position? Colin. So Collins, I hear your question, and I think I already answered that question. If you're a real estate professional, it allows you to be able to take your ordinary losses, your losses from that business, because real estate has a lot of business of losses that are possible as long as you know how to structure it. So real estate, you can take those losses from there and then basically include them in, and then use them against your ordinary activity, which is your W-2, all those incomes that you make here. Because you are in real estate, you can take, and you qualify as a rep, you can take those activities that will otherwise be considered passive activities. You can take those losses, passive activity losses that will otherwise be considered passive activity losses. Because you're a real estate professional, you can take them. They are considered now ordinary activity. So you can take the losses from there and wipe off all your $1 million that you made as income from W-2, and then you pay no taxes. But you have to qualify as a real estate professional. Yes, any business structure can be an NPO. That is correct. So any business structure, generally you have corporations, people generally create corporations and then they convert them, they go and then ask for, you have to fill a form called, it's called form 20, it's called form, I think it's, what is that form called? It's form 1. I've forgotten that form, but we fill the forms all the time. It's an application. They have the long form and you have the short form, and it's the application for registration as a nonprofit. So you start by registering the company, and then you can go from there and then apply for exemption status. Generally 90% of nonprofits are 501c3s. Can losses from my side hustle be used to offset gains from my W-2? That is right. If you qualify, if you basically, passive activity losses are only going to be used against passive activity income. Passive activity is any activity for which you are not actively involved. Now, if you're actively involved in that activity, then like we just talked about a real estate professional, if you're actively involved in an activity, if I could have my business, I have maybe 3 businesses. And then on those three businesses, I have my W-2 coming from one business. Then the other ones, I'm working on that one. The losses that are incurring on those other business, I can take them and wipe off all my income from W-2 with them. Yes, for tax purposes. So I think we have somebody's asking me about, can I use my wife's social HSA for plan for my medical? Absolutely, you can use it because you are basically a dependent on your wife's health savings account. So you are a dependent. Your children are also dependent. If it's not a family plan and it's just an individual plan, then you can, as long as those expenses qualify as healthcare expenses for prescription drugs and certain things, you can basically use them. Yes. So I just want to thank you guys. I want to tell you one thing. I think what we're going to do going forward is that we will take this thing from just being a normal web program. I'm going to do a podcast where it's going to be a lot of live questions because I have a lot of questions coming through that I can't respond to them. Guys, do us one favor. Go online, follow us on YouTube, follow us on Instagram, share our videos, make people recognize that we're giving a lot of value out here. Follow us, like us. Whatever you have to do, click the notification button, just share so that people can know us. And I just want to thank you guys for taking the time today to participate in this. My microphone was here. For some reason, it's not working, so I had to raise my voice. But going forward, I hope you guys understood what we were talking about. And I just want to thank you all for being here today. I hope you guys are going to take the step and some of these tips that we just talked about today. If you're trying to do it and you're struggling with implementing those tips, please contact us. We're going to help you do it. Thank you, thank you, thank you. And you have an excellent rest of your day. Bye-bye, bye-bye, bye-bye. Ooh, that was a good turnout today. Thank you so much for waving. I enjoyed that. Thank you so much. Thank you. I appreciate you guys for coming on. I appreciate you guys for coming on. I appreciate you guys for coming on. Yeah. Ooh, that was a long one.